Your parents, or your grandparents, most likely retired at 65 and never gave it a second thought. That was simply the number. It was printed on brochures, repeated at retirement parties, baked into how an entire generation planned the last third of their lives. If you were born in 1960 or earlier, you do not get that luxury. And as of this year, it is official, on paper, in a letter with your name on it. I am not here to panic you about that. I am here to hand you the 8 or 9 specific numbers that actually determine what your Social Security check looks like in 2026. Numbers that are all public, all published, and almost never explained together in the same place at the same time. By the end of this, you will know more about your own situation than most financial newsletters bother to spell out, and you will know exactly which of these numbers actually apply to your specific birth year instead of a generic version aimed at everyone at once. Here is a quick piece of insider knowledge before we even get into the main list, because it is new enough that most people watching this have not heard it yet, and it could be worth thousands of dollars depending on your income. Buried in a federal tax law passed in 2025, there is a brand new deduction specifically for people 65 and older, worth $6,000 per qualifying person, available for tax years 2025 through 2028, stacked on top of your regular standard deduction. A married couple where both spouses are 65 or older can claim $12,000 off their adjusted gross income. That deduction starts phasing out around $75,000 of income for single filers and $150,000 for married couples, disappearing entirely somewhere around $175,000 single and $250,000 married. For a huge number of middle-income retirees, this deduction is large enough to pull their income back below the thresholds that determine whether Social Security itself gets taxed, which we will get into in detail in a few minutes. Most tax preparers are aware of it. Not all of them are proactively applying it unless you specifically ask. Hold on to that thought because it connects directly to numbers 3 and 4 on this list. Quick housekeeping. I track Social Security, Medicare, and retirement rule changes the moment the agencies themselves publish them, every single week, not the recycled version that shows up in your feed a month later. If that is useful, subscribe and turn on the bell right now because there is a second update behind this one that most channels have not covered yet. 2 seconds, and let's get into the full list. Before the list, a short version of why this year specifically matters. In 1983, with the Social Security Trust Fund, Congress passed a set of reforms that, among other things, raised the full retirement age, the age at which you collect 100% of your benefit with zero reduction, from 65 up to 67. Rather than force one generation to absorb a 2-year jump overnight, lawmakers phased it in over roughly 4 decades, 2 months at a time, tied to birth year. That climb finally finishes this year. Everyone born in 1960 or later now has a flat full retirement age of 67. The full ladder, spelled out, looks like this. Born 1943 through 1954, full retirement age 66, flat. Born 1955, 66 years and 2 months. Born 1956, 66 years and 4 months. Born 1957, 66 years and 6 months. Born 1958, 66 years and 8 months. Born 1959, 66 years and 10 months. Born 1960 or later, a flat 67. Everyone born in 1958 or earlier was already locked into their exact rung on that ladder in prior years. The transition period that started under Reagan is now officially closed, more than 40 years after the amendments that set it in motion, quietly outlasting several presidents, several recessions, and multiple predictions that the program would not make it this far intact. Number 1 on the list, and the one that determines everything else. Know your exact full retirement age, down to the month, not the year everyone assumes it is. Claim at 62, the earliest age allowed, and if your full retirement age is 67, your benefit is reduced by roughly 30% permanently for as long as you live. Wait past your full retirement age instead, and your benefit grows by roughly 8% for every year you hold off, up until age 70, where the incentive stops and 70 becomes your practical ceiling. On a benefit that would be $2,000 a month at full retirement age, claiming at 62 likely puts you closer to $1,400 a month for life, while waiting until 70 could push that same benefit toward $2,480 a month. That is a swing of roughly $1,000 every month, over $12,000 a year, sitting entirely on a filing date. Here is the insider piece almost nobody mentions. The exact birth year changes this math in ways people miss. Someone born in 1958 has a full retirement age of 66 years and 8 months, a full 4 months earlier than someone born in 1960. Treat those two people as though they share the same number, and one of them ends up claiming a full year earlier than their actual full retirement age without realizing it, taking a reduction they never intended. The action step is a 5-minute login to your personal My Social Security account at the official ssa.gov website, where your exact number, calculated from your own earnings history, is sitting there waiting, along with projected benefits at 62, at your full retirement age, and at 70. If you have never created that account, here is exactly how. Go to ssa.gov, choose to create a personal My Social Security account, and verify your identity through either login.gov or id.me, typically a quick process involving a few credit history questions or a photo of your driver's license. Once inside, you will see your full earnings record stretching back to your very first job, along with benefit projections built from your actual numbers instead of a generic table. If a year of earnings looks wrong or missing, flag it directly with the agency, because that record is exactly what your future benefit gets calculated from. Number 2, and this is the one that shows up first in your actual deposit, the 2026 cost of living adjustment. Benefits rose 2.8% this year, translating to roughly $56 a month more for the average retired worker. This is not limited to retirement benefits either. Supplemental Security income, which supports roughly 7.5 million of the lowest income recipients, rose too, with the maximum federal payment for an individual increasing from $967 to $994 a month, and for an eligible couple from $1,450 to $1,491. Social Security disability insurance recipients saw their average monthly benefit rise from about $1,586 to about $1,630. All of these numbers trace back to the same formula, the Consumer Price Index for urban wage earners and clerical workers, comparing the third quarter of one year against the third quarter of the year before. When prices rise, your check rises with them. When they do not, your check simply holds flat rather than shrinking, something that has only happened 3 times since these automatic adjustments began in the 1970s, in 2010, 2011, and 2016. And it has never once actually gone down because of this calculation, regardless of what prices did that year. Number 3, and this is the number that quietly cancels out a chunk of number 2 before you even notice, the Medicare Part B premium. It rose from $185 a month in 2025 to $202.90 a month in 2026, an increase of roughly $17.90, just under 10%. For most beneficiaries, this premium comes out directly from the Social Security deposit before it ever reaches your bank account. Run the actual math. A $56 COLA increase minus an $18 Medicare increase nets out to roughly $38 a month, not $56. This is almost always the real explanation when someone says their raise disappeared. It did not disappear. It just moved to a different line item inside the same deposit. Invisible unless you specifically know to look for it in the message center of your My Social Security account, where both figures are broken out separately. Number 4 connects directly back to that insider deduction from the top of this video, because this is where it actually pays off. The income thresholds that determine whether any part of your Social Security benefit counts as taxable income were set at $25,000 for single filers and $32,000 for married couples back in 1983. With a second higher tier added in 1993 at $34,000 single and $44,000 married. Those thresholds have never once been adjusted for inflation. When they were written into law, roughly 1 in 10 beneficiaries owed any tax on their benefits. Today, it is closer to half of all recipients, not because Congress rewrote the rule, but because every COLA increase and every dollar of pension or retirement account income pushes more people over numbers that have been frozen since the Reagan and Clinton administrations. This is exactly where that new $6,000 senior deduction earns its keep. Because it directly lowers your adjusted gross income, it can pull your provisional income back under those frozen thresholds entirely meaning some retirees who paid tax on their benefits last year may owe nothing this year, purely because of a law most people have not heard of yet. The action step is to ask your tax preparer this exact question by name, whether the new senior deduction changes your Social Security taxability, because it is recent enough that it is not being applied automatically everywhere. Related to this, if you hold a traditional IRA or similar account, required minimum distributions currently begin at age 73, a rule in place since 2023 under the Secure 2.0 Act, scheduled to rise again to 75 in 2033. It is not new this year specifically, but it interacts directly with everything above it, because a larger required withdrawal can be exactly what tips your provisional income over one of those frozen thresholds, right as the new senior deduction is working to pull it back down. Whether those two forces cancel out or not depends entirely on your specific numbers, which is exactly why this is a conversation for your tax preparer and not a guess. Here is what this looks like when someone actually runs the full picture instead of guessing at pieces of it. Picture a retired couple, both 67, living on a combined Social Security income plus a modest pension. Run separately, each individual piece looks unremarkable, a COLA here, a premium there. Run together, with both spouses claiming the new $6,000 senior deduction each. Their combined $12,000 reduction in adjusted gross income is enough to drop their provisional income back under the $44,000 married threshold, moving them out of the tier where 85% of their benefits would otherwise be taxable and into a tier where a meaningfully smaller share is. That is not a hypothetical loophole. It is simply what happens when you actually stack the current real rules together instead of evaluating each one in isolation the way most financial content covers them one at a time. Do not forget your state might be taking its own separate bite too, or it might not be touching your benefit at all. Currently, 41 states plus the District of Columbia do not tax Social Security benefits under any circumstances. Only 9 states still tax benefits to some degree: Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, and West Virginia, and even within those 9, most carve out partial exemptions or age-based deductions that mean a typical middle-income retiree often owes little or nothing at the state level, regardless of the state's general reputation. Search your own state's Department of Revenue website for retirement income exclusion before assuming anything based on what you have heard secondhand. Number 5 is the one that trips up people who are still working. If you have not reached your full retirement age for the entire year, you can earn up to $24,480 in 2026 before Social Security withholds anything, and above that line, it withholds $1 for every $2 earned. In the specific calendar year you reach your full retirement age, that limit jumps to $65,160, with the withholding easing to $1 for every $3 above it. Once you are fully at your full retirement age, the entire test disappears. You can earn any amount with zero reduction. Here is the insider detail that almost never gets explained clearly. Money withheld under this test is not lost. It gets recalculated back into a higher monthly benefit once you reach full retirement age. People quietly cut their work hours out of fear of this rule constantly, not realizing the withheld amount comes back later in a different form. Know which limit applies to your specific year before making a decision about your hours based on fear instead of the actual rule. Number 6 is on the tax side for people still earning a strong income. The maximum amount of earnings subject to Social Security tax rose to $184,500 in 2026, up from $176,100 the year before. If your income sits above that line, slightly more of it gets taxed for Social Security this year than last year, funding the same system paying today's beneficiaries. It is worth noting this cap only affects earnings up to that specific dollar figure. Every dollar above $184,500 this year is not subject to the Social Security portion of payroll tax at all, which is a detail that surprises people who assume the tax simply applies to all income without limit the way Medicare's payroll tax does. Number 7 is the one that came out barely a month before this video, and it is more current than almost anything you will find searching this topic. On June 9, 2026, the Social Security Board of Trustees released its annual report on the financial health of the trust funds, and the projection moved. The Retirement Trust Fund, formerly the Old Age and Survivors Insurance Fund, is now projected to cover 100% of scheduled benefits only through the fourth quarter of 2032, one full quarter earlier than last year's report. After that point, without congressional action, ongoing payroll tax revenue alone would still cover about 78% of scheduled benefits. Combine that fund with the smaller, healthier disability insurance fund, and the runway stretches to the third quarter of 2034 at 83%, though merging the two funds that way would require new legislation. Here is the insider context worth knowing. This is not the first time this program has faced a hard deadline. In 1983, the trust fund came within months of being unable to pay full benefits, and the reforms passed under that pressure are the exact same reforms that just finished phasing in your full retirement age this year. That is not a guarantee history repeats. It is evidence that this specific program has been patched under pressure before rather than allowed to fail outright. This is a funding projection, not a shutdown, and treating those two things as identical misrepresents what the trustees actually said. For scale, the same June report noted that combined trust fund reserves declined by about $160 billion during 2025 alone, leaving roughly $2.56 trillion in reserve heading into this year, a number large enough that depletion is a multi-year runway, not a light switch. While we are on the notice itself, here is exactly what to look for when yours lands, whether on paper or in your account's message center, instead of skimming past it. Near the top sits your new monthly benefit amount for 2026, already reflecting the 2.8% increase. Just below it, if you are enrolled in Medicare, is a separate line showing the Part B deduction, which is where that $202.90 figure actually gets subtracted from your gross amount before the deposit hits your account. If you are within a few years of full retirement age, some notices spell out your exact full retirement age date down to the month, worth comparing directly against whatever number you may have been assuming. And if you have not filed yet, the absence of a dollar figure on your notice does not mean none of this applies to you. It means the earnings limit and full retirement age numbers we just covered are the ones actually relevant to your specific situation right now. Number 8 applies if you are married, widowed, or divorced, because none of this is only about your own individual number. Spousal benefits can be worth up to 50% of your spouse's full retirement age benefit, reduced in that same permanent way if claimed before your own full retirement age. If you are divorced and the marriage lasted at least 10 years and you have not remarried, you may still be entitled to a benefit based on your ex-spouse's earnings record. And here is the detail that surprises almost everyone who hears it for the first time. Your ex-spouse does not need to have filed for their own benefit yet, and they are never notified that you claimed against their record. For widows and widowers, a surviving spouse can receive up to 100% of the deceased spouse's benefit, with eligibility starting as early as age 60 or age 50 if disabled. And if the spouse who passed away had delayed their own claim past their full retirement age, the surviving spouse inherits that larger, higher benefit rather than a smaller one. Remarriage changes some of this. Remarry before age 60 and you generally lose eligibility for survivor benefits tied to a deceased former spouse, though remarrying at 60 or later protects that eligibility. Remarry at any age while collecting a divorced spouse benefit based on a living ex, and that specific eligibility generally ends, tied to the new marriage instead. Let me clear up 2 myths quickly before we wrap this up, because they come up constantly in comment sections on this exact topic. The first is the belief that claiming Social Security and retiring from work are the same event. They are not. You can file for benefits and keep working at the same time, at any age, subject only to the earnings test we already covered if you are under full retirement age. Full retirement age governs your benefit calculation, not whether you are legally allowed to keep a job. The second myth is the belief that once your monthly number is set, it never moves again. It does move. Every beneficiary, regardless of when they filed, receives the annual cost of living adjustment on top of their existing benefit. And anyone who had earnings withheld before reaching full retirement age sees that reflected in a recalculated higher check once they get there. The third myth is the idea that there is one single correct age for everyone to claim, some universal right answer being kept from you. There is not. The math on early versus delayed claiming is the same for everyone. Roughly a 30% reduction at 62 versus roughly 8% growth per year of delay up to 70. But which side of that trade makes sense for you personally depends on your health, your other income, whether you are married, and how much you actually need the money the year you turn 62 versus the year you turn 70. The numbers are universal. The right decision is not, and anyone selling you a single one-size-fits-all age is skipping the part where your situation is actually different from the next person's. So here is the full list, side by side, in the order that actually matters for your own decision. Know your exact full retirement age down to the month. Understand the 2026 COLA and what it means before Medicare takes its cut. Know the actual Part B premium so the math on your deposit makes sense. Ask about the new senior deduction and how it interacts with the frozen taxation thresholds. Know your specific earnings limit if you are still working. Understand the updated trust fund timeline well enough to separate a funding projection from a shutdown. And if you are married, widowed, or divorced, treat spousal and survivor benefits as a household decision, not an individual one made in isolation. None of these 8 numbers are secret. The full retirement age table lives publicly on ssa.gov. The COLA figure was announced in October. The Medicare premium is published by CMS every fall. The tax thresholds are written into the tax code for anyone who wants to look. The new senior deduction is in the actual text of the 2025 tax law. The Trustees Report came out in June, covered by every major outlet the same day. The problem was never that this information is hidden from you. The problem is that it is scattered across 8 different agencies, on 8 different release schedules, in 8 different formats, and almost nobody sits down and connects it into the one decision that actually determines your monthly income for the rest of your life. That is the actual gap this video exists to close, not a secret nobody wants you to know, but a connection nobody bothered to draw for you until now. Think about how differently this plays out for 2 people with the same birth year who handle it 2 different ways. One person opens the notice, sees a benefit number, assumes it is simply what it is, and moves on without checking the full retirement age date against what they remembered, without asking about the senior deduction, without running the survivor benefit numbers with their spouse. The other person spends 20 minutes doing exactly what we just walked through, confirms the exact month their full retirement age lands on, asks their preparer one specific question about the new deduction, and has one conversation at the kitchen table about who should delay claiming if something happens to either of them. Both people received the same letter. Only one of them actually understands what it says, and over a 20 or 25-year retirement, that gap in understanding is worth real money, not a rounding error. So this week, do the actual work once, and you will not need to redo it for years. Log into your My Social Security account and confirm your exact full retirement age along with your estimated benefit at 62, at full retirement age, and at 70. If you are 65 or older, ask your tax preparer by name about the new senior deduction and whether it changes what you owe on your benefits. If you are still working, write down which specific earnings limit applies to you this year. If you are married, sit down together and run the spousal and survivor numbers as a household, not separately. And when your notice actually arrives, whether on paper or in your account's message center, read the whole thing, because the specific numbers in it are calculated for you, not for the average retiree in a national headline. If this connected some dots for you that had never been connected before, hit like so it reaches someone else who is still piecing this together from 8 different tabs open in their browser, and subscribe if you have not, because I put these breakdowns out the moment the source agencies publish them, not weeks later, not after someone else has already covered it first. Tell me in the comments which of these 8 numbers you had never heard explained clearly before today, and whether your birth year lands you in the 66 and something group or the flat 67 group. I read every comment, and it is genuinely what decides what gets covered here next. Your parents never had to think about any of this because the number never moved under them the way it just finished moving under you. That is not bad luck. It is simply the year you happen to be standing in, and now you are standing in it with the actual numbers in hand instead of the version everyone assumed was still true.